Hello, I'm Dan Sweeney, the Director of the Institute for Enterprise Ethics at the Daniels College of Business here on the University of Denver campus. I am pleased to present the third quarterly ethics review. This program features several outstanding faculty members from the Daniels College of Business discussing a number of the most interesting and widely reported issues from the world of corporate ethics and corporate responsibility over the past 3 months. In this session, we will talk about the Dodd-Frank mandated whistleblowing program, new court decisions in the insider trading area, and Uber's successes and problems, and then several quick hit issues at the end. My colleagues for this discussion are 3 relatively new additions to the Daniels faculty. Bruce Claw is an assistant professor in the Business Ethics and Legal Studies Department. Bruce specializes in the study of white-collar crime and has practiced law in both public and private practices. Aaron Nickel is an assistant professor on the faculty of the School of Accountancy and a former senior audit associate with Grant Thornton. Paul Seaborn is an assistant professor in the management department. Paul's earlier career was as a management consultant with both Mercer Consulting and with IBM. Well, panel, let's get with it. Bruce, so in December, the Second Circuit Court of Appeals swept away the convictions of 2 people recently tried and found guilty for insider trading. Also in December, the SEC dropped charges against another suspect. And in January, 2 more suspects filed motions to eliminate all their charges on insider trading. All this on the same issue. The issue, did the investor receiving the information from the source know whether or not the source received any personal gain in exchange for providing that inside information? Now, this awkward question comes up only because the United States does not have an actual explicit law prohibiting insider trading. So, will trading on inside information be kind of okay from now on unless the trader knows that the source received some kind of personal gain? And wouldn't it be helpful if we had an actual statute to prohibit insider trading?
Thanks, Dan. The case you're referring to is U.S. versus Newman, which was handed down in December. And let me take the first, or your second question first, which is, would it be helpful to actually have a insider trading statute? Absolutely it would. Part of the reason we're ending up with these awkward legal decisions is because there is no dedicated statute designed purely to insider trading. As it stands, most insider trading is now prosecuted under what's known as an anti-fraud statute, an anti-lying statute. And that's created confusion going back at least 30 years. There was a case back in the 80s that basically decided this. In order to be convicted of insider trading, if you receive a tip of non-public material information, it is only illegal to trade on it if the person who gave you that tip did so in breach of their fiduciary duty to the corporation for which they work. Basically, the concept is this, that when insiders, like corporate CEOs, work for a company, they gain access to certain material inside information that is designed to benefit their shareholders and their prospective shareholders. It's a violation of their duty when they start tipping out that information with an improper motive that's not designed to benefit the corporation itself or its shareholders, but rather to personally benefit themselves. So the Supreme Court in that case basically decided they're not going to have a rule that requires perfect informational symmetry between all traders on the market, but rather it's only a function of whether or not the CEO or a corporate insider or misappropriator is using that information improperly for their own personal benefit. And so the law had progressed to the point where in order for a tippee to be liable for trading on inside information, they must receive a tip of material non-public information. That tip must have come from an insider or a misappropriator in breach of their fiduciary duty to the corporation and in receipt of a personal benefit, that basically the insider got something in exchange for doling out that information. And in this case, in U.S. versus Newman, the Second Circuit Court of Appeals effectively extended that law in two different ways. First, they said that not only must the government prove that the insider received some sort of personal benefit in exchange for tipping out that information, but also that the tippee, the person who receives that tip, must be aware that that tipper, that insider, received a personal benefit in exchange. Now that's fairly easy in very direct cases where the CEO tips somebody in exchange for direct cash. It becomes very tricky, however, when we have a chain of tippers and tippees that goes down 3 or 4 levels, where the sort of inside tip is passed down through a chain. And so now, in order to effectively prosecute under this law, prosecutors have to show that that 3rd or 4th level tippee down the road has to somehow be aware that the tip that he received of material non-public information came from an insider, and then that insider received some personal benefit for it, which is going to be very difficult to prove in almost all cases. Second, what the court did is it changed kind of the definition of the personal benefit requirement. It had been understood previously that a director or an officer receives a personal benefit either when they get cash in exchange for it or when they freely gift out that information to their best buddies. Let's say on the golf course, the CEO, is hanging out with his friend who works at a fund or an investment bank, and gives out that information to his friend or buddy kind of gratuitously. It would almost be the same thing as if the CEO took that non-public information, traded on it himself, made profits, and then handed cash to his buddy over at the investment bank. So what the court did in this case is it basically said, now, in order for that personal benefit requirement to be satisfied, there needs to be a meaningfully close relationship generating an exchange that is objective, consequential, and represents at least a potential gain of pecuniary or similarly valuable nature. So basically, it's almost got to be money. That mere gifting the tip to your buddy at the investment bank isn't enough. And so it's going to be tremendously difficult for prosecutors to successfully prosecute market cheaters, insider traders, unless this ruling is overturned. And now the government is really is pressing for this to be overturned. On Friday, they filed a motion for a much larger appellate review of this decision, which is extremely rare. They're not focused on that knowledge requirement that the insider or that the tippee know that the tipper received a personal benefit, but they are really focused on the nature of what that personal benefit means. The government does not want to have a situation where they have to show that there was effectively an exchange, an explicit exchange on the golf course in order to be able to prosecute. Because in reality, the exchange of tipping information doesn't happen that way. It's often done for the prospective future relationship building in the hopes that they'll get investments in return.
It seems to me this is yet another situation where the courts are basically, their hands are tied. They're dealing with the laws as they've been given to them. As you say, we don't have a law specifically for insider trading, so they're using other laws that have been somewhat workable over the last while. It almost seems like now, with these very narrow definitions that you're describing, you could think of, a creative person could come up with a lot of ways to somehow exchange benefits that are not going to be observed, not going to be easily tracked. I mean, do you think that this is going to take the abilities of the SEC to prosecute insider trading to such a weak point that we might actually get an insider trading law? Is this actually maybe a step backwards to take a step forwards, or do you see this as just we're going to never see anyone nailed for insider trading for the next little while?
Well, ultimately, I think it's going to be substantially harder to gain these prosecutions, and I'm not sure there's the political will there to make a statute. At the end of the day, a lot of Congress's campaign funds come from folks on Wall Street, and while business would certainly appreciate some clarity as to what's where that line is between sort of aggressively seeking out information and doing appropriate research, and on the other hand, sort of cheating the market, I don't know that all of them really want it to be so clear and cut and dry so that they don't have leverage. So I'm not sure we're going to see a statute here, unfortunately, at least in the short term.
So is it going to be like free time for insider traders for the next period of time?
Well, until this ruling is overturned, I think you're going to see a lot more people trying to get very close to the line of what's appropriate and what's not. And they're going to not make it clear that they're getting some personal benefit in exchange. And of course, the folks who work at various hedge funds, they're going to make sure that when they do receive a tip of material non-public information, they're going to not want to know who the source was. They're not going to want to confirm that it came actually from an insider, and they're going to make sure that they have no knowledge of any personal benefit that was exchanged. They're going to say, well, it was merely friendship, and at least as this court ruling stands now, that's not going to be enough for insider trading.
How is this going to affect the operation of these information brokers that are so active, especially, I think, in the pharmaceutical industry and other industries, who make it a practice of finding information within the industry and then making it available under their consulting practice, which may just be a retainer? Is that going to help these firms or constrain them?
Well, I think it's going to become much more lucrative if you're the type of person who can form friendships with insiders and bona fidely claim that they were, actual genuine friendships. What this court ruling basically says is the mere fact of a friendship alone is not enough to show that you got a personal benefit. And so the price of friendships just went up.
Good day for friends, to have friends. Yeah. In the past, some really high-profile insider trading cases have been made using wiretaps. Is that going to be kind of the move du jour to get these?
I think so. I think prosecutors, unless they're able to overturn this ruling, they're going to really have to seek out aggressive ways to, if they want to go after remote tippees, the people at the end of the chain, they're going to have find out ways to make sure that they can prove that end of the line tippee knew that there was a personal benefit being exchanged by that original insider. And the best way to do that, of course, is to catch somebody on tape.
Especially when that somebody is a former managing director of McKinsey International, right?
Yeah, we saw some of this in the Raj Rajaratnam case.
Yeah, it's a big check mark on the prosecutor's scorecard, right?
Absolutely.
Yeah. Well, good. Thanks. Thanks for shedding some light on that and giving me some perspective on it.
My pleasure.
Okay, Bruce, we've got a question from the audience here. Could these new insider trading laws open up anonymous online forums where insiders can deposit information and people with special access can see it? What do you think?
It's entirely possible. From the tippee's perspective, that'd be a good way to gain material non-public information, although if you're putting it on the web, it somewhat becomes public. But you'd be able to trade on it, and there'd be no way to show that you knew who the source was or that the source received a personal benefit. On the other hand, folks who would post those kinds of tips would be very likely to get caught and fired and ultimately violate other SEC regulations like Regulation FD, which says you can't selectively disclose information.
Aaron and Paul, do you have any view on that?
Yeah, this all seems to come up against our expectation of market efficiency, which is we want information to get out there as quickly as possible, to be incorporated into the stock price, and anything that hinders that process, leads to opportunity for insider trading. So we're in a kind of catch-22 where we want information to get out there and be freely available, but yet, if you're the one posting on this particular website, you're probably going to be the one who is easily tracked by IP address and busted. So.
Okay, good. Thanks. Aaron, it was reported in December that consistent with certain requirements of the Dodd-Frank law, 4 whistleblowers shared a $170 million payout for helping to get a record $16.65 billion settlement from Bank of America for mortgage abuses. In 2014, that is in last year, the SEC received a total of 3,620 whistleblowing complaints. Also, across the country, law firms are building specialized whistleblowing practices so they can share up to 2/3 of the payout with their clients. It seems that this well-intentioned idea has gotten a bit out of hand, and in fact may be producing some pretty perverse incentives. One wag referred to it as a whole new career strategy. Quote, sign up to do bad stuff, call the FBI, make a bundle, repeat, end quote. So what do you think about this whole whistleblowing bounty program from the SEC?
Okay, thanks, Dan. To summarize, the concern is that, you know, the B word is a little bit of a strong word, in my opinion, but it does highlight the concern that by providing this a large sum of money to whistleblowers, we are incentivizing them to not only detect fraud, but maybe commit fraud in order to detect it. And in my opinion, that seems like a little bit of a stretch. First of all, it's not easy money to come by. If you're going to be a whistleblower, not only are you putting your own career in jeopardy, but you're also sacrificing some reputational things as well, and these are likely people that you work with and people that you're friends with that you're blowing the whistle on. So it's not easy money to come by from a financial perspective and a reputational perspective. Furthermore, it's not something that happens quickly either. So if you're going to blow the whistle on a company that you work for and then report this information to the SEC, you're not going to make money fast. It's going to be a long time before you see a dime. And in the meantime, you're likely to suffer. And there are anti-retaliation clauses in the Dodd-Frank Act to protect against companies retaliating against the whistleblowers. But even so, it's very likely that they're going to still suffer in the meantime. So again, it's not easy money. And then secondly, the amounts payable to whistleblowers, this $170 million, sounds like a lot of money. But when you compare it to the amount that was recovered, it pales in comparison. So the SEC estimates that they were able to recover approximately $21 billion in funds from litigation that was spurred by whistleblowers. So they can attribute a large amount of money recovered to the fact that they have this whistleblower incentive program. So I think that the incentive for whistleblowers is the incentive that we should be focusing on. The incentive for them to sacrifice as much as they're sacrificing in order to come forward. And the reason is that there's really no good way to detect things like this without whistleblowers. We need them to participate. We need people that are on the inside to come forward in order to prosecute frauds of this magnitude, particularly with the fact that we've got such complex transactions these days. We have an increase in the use of fair value accounting and unobservable inputs in these models that they're using to estimate the value of certain securities, and it's just very difficult to prosecute. And lastly, I want to say that maybe that's what we want. Maybe we want to put the fear in these potential criminals that their buddy or someone that they work with is going to sell them out. Maybe that's what we want. It's actually going to be a preventative measure as well.
Yeah, I don't think I have very many concerns about this in the short term. I mean, as Aaron says, the SEC is recovering $21 billion at the expense of $170 million. It seems like a good investment. And the SEC only has so many resources and so many investigators, and it's, there's no way they can cover all the potential wrongdoings out there. But I would have a concern in the long term that, if that whole preventative, watch out for your neighbor ratting on you effect doesn't come through, the opposite might be that the SEC's investigative abilities kind of atrophy or disappear, and then we're completely reliant on these whistleblowers for any enforcement of violation. And so I guess I would hope that in the long term there's still some consideration of either some sort of increased disclosure, using technology. We should be able to monitor these companies a little more closely maybe than we could in the past. Or maybe some idea of actually strengthening the SEC's resources as well. My understanding is that they're supposed to be a basically revenue neutral government agency. They get some fees from listings and other things, and that's their budget. Maybe throw them a little bit of money, and so maybe they can be a little bit stronger as well. But yeah, I agree with you. In the short term, it seems like a good investment to get some wrongdoing uncovered.
Well, I couldn't agree more with you guys. I mean, I think that's exactly right. I mean, as you guys know, there's a tremendous literature out there on crime prevention, and what it basically says is that in order to prevent crime, it's a function of three factors, right? There's got to be a severity of punishment. a swiftness of punishment, and a likelihood of detection. And it's that third prong, that likelihood of detection, on which current efforts are failing, because people keep these schemes secret, obviously. And so in order to change that calculation going on by the wrongdoers, we really got to increase the likelihood that they're going to get caught. And in the absence of more robust disclosure rules, like you're pointing out, this is one of the only ways to really increase that likelihood of disclosure.
Let me add one more question onto this thing. Starting in around 2000, Sarbanes actually put some requirements on boards and on governance to have an inside the organization hotline or some way of surfacing whistleblowing kinds of issues within the company. And over the next 10 years, and when I was sitting on a couple of boards, I think that most companies did a pretty good job of establishing that. And then when Dodd-Frank came along and said, now, that's fine, but we'll give you a couple of $1 million if you go outside and don't go inside. I know I'm a little biased on that issue, but what's the relationship between going to the SEC and going inside?
Well, there are certain types of employees and certain types of personnel that are required to go inside before before they're able to receive a reward, and that would be internal audit and compliance personnel are required to go internally. And I think that they do hope, the SEC does express hope that personnel will go inside, internally report first, and that would strengthen their case in the event that they were going to apply for a whistleblower reward, having already have gone inside, reported internally, and then there still have been nothing to come of it, is going to strengthen their case. So they do benefit from going internally. But I do agree that it's a long-term concern.
Yeah. Any other comments on that? That was good, thanks. I had some keen insights there. Appreciate it. Aaron, we've got a question from the audience. Do you think there needs to be a cap on the level of these payouts to individual whistleblowers?
I think that's a great question, and I think it's definitely worth considering. But at the end of the day, I think it's an empirical question, and I think there needs to be a lot of research done on whether or not the amount of the payout makes a difference in the outcome of the case or in the likelihood that a whistleblower will come forward. And so these are all things that we should look into in the future and research and study.
Bruce, Paul, any comments on that?
Well, right now there's a lot of flexibility in the amount that's actually paid. It's somewhere between 10 and 30% of the amount that the government ultimately recovers over and above $1 million. So there's already, somewhat of a cap on the 30%, but it's not a hard monetary cap. And I agree with Aaron. I mean, you want to make the bounty enough that whistleblowers can come forward and are willing to disregard the reputational consequences that are going to happen to them when they come forward and whistleblow. At the same token, you don't want to encourage wrongdoers to get paid out.
Right.
So, Paul, Uber, the quote ride-sharing service, I say that in quotes because they don't like to call themselves that, appears to be the archetype Silicon Valley startup. This is a company that calls itself an information service. It prides itself on being a disruptive technology. It's expanding rapidly in a global market. It's executing a clear and very successful strategy. It claims to have what they call a fierce culture. It's growing revenue by about 40% a quarter and boasts a valuation of over $41 billion. But Uber has come under some pretty heavy criticism recently for some of its operating policies relative to issues like privacy, safety, respecting local government regulations, hiring practices, and so on. The company has, in fact, been banned from several European and several Southeast Asian countries. So, Paul, what more could a good venture capitalist want? I mean, at what point does a high-tech, disruptive business become a legal and ethical scoundrel or maybe even outlaw?
I think it's a great question, and it's really a matter of perspective. I think if you think of venture capitalists, There may be a few highly religious venture capitalists, but I don't think any of them take the view of the meek shall inherit the earth, and we want a very mild and cautious company as our future payout. So when you look at a venture capitalist, they want a company that's aggressive, that can grow quickly, that can go from one geographic area and scale, and that's exactly what Uber is giving them right now. They look at markets. If there's some question of whether they are legally entitled to operate, if they're not being welcomed by the local taxi companies, they don't just move on. They look at that as an opportunity. They jump in, and I think part of their value proposition to VCs is what they don't do. They don't own vehicles. They don't have a taxi depot, a physical building. They don't get tied up in a lot of the local day-to-day operations. They have a technology platform that is able to match supply and demand, and they think they can scale that and do it for deliveries, for parents who need to get their kids to piano lessons, and that they have a value proposition that will actually work. So I think from a VC point of view, there's very little to be concerned about, and other than a few recent blips on the road that we can talk about in terms of security and privacy. Obviously, if you're the incumbent industry, the taxi companies are going to say, these are outlaws, they're not following the rules that we follow, and they should be shut down, and that's obviously in their interest. So I think those two perspectives are clear. The question that's in flux right now is, what do the public think, what do government think about Uber? And I think that's where we should look at safety and privacy as probably two key points for Uber. On the safety side, I would say the question is Uber actually doing worse, or are they doing better than the other alternatives of you get in a taxi with someone that you don't really know, in a vehicle that you don't really have a lot of information about, or you walk, you take a bus, other things. And so I think some of these incidents, like the issue in India, some people may have heard of, where an Uber driver was actually charged with raping a customer, and they, as a result, were shut out of the country, at least temporarily. On the face value, that sounds horrible, it sounds terrible, it sounds like maybe an end to Uber's credibility. But then when you look at the details, they went into this country, they hired a licensed commercial driver who was fully qualified to drive vehicles in that country. It just turns out that person had been charged and never convicted of crimes, and he did this under Uber's umbrella. So obviously there's something to be done there, but at the same time it's not clear that they're any less safe than the alternatives. And then on the privacy side, which I think is something we should all think about, is Uber has more information about us if we're users than pretty well any company you can imagine. They know where we go, where they're dropped off, what time of day, how we paid, a lot of details that could be used in a lot of different ways. And I think that's probably the area where they've had some missteps. They had this God view where employees could actually look and see any individual that they were curious about where they were in the world and what they were doing. And similarly, this little report they issued on glory rides of folks getting dropped off late at night in a new neighborhood, getting picked up early in the morning, shortly after, I wonder what's going on in these transactions. Clearly that's not a good thing. Venture capitalists would not endorse that, but I think that may just be a growing pain and not a fatal flaw. And I think in privacy, they have an opportunity to maybe set a standard and actually show some leadership on how to use these new data sources that no one else has really thought about, government or other companies. So I think overall, I think the scoundrel outlaw label is not quite stuck yet, and we'll have to see how it turns out.
Well, I think you're completely right that we need to sort of separate out the issues of sort of privacy and safety versus issues of, launching an attack on existing taxi companies. I'm all in favor of new disruptive technologies coming in, lowering the price of taxi medallions, giving more money to drivers, and shaking up sort of needless regulations. On the other hand, some of the regulations that govern taxi companies don't necessarily yet govern ride-sharing services like Uber and Lyft. And so one of the relevant questions is, well, who has to conduct a background check on the driver? Is that something that the government should have to do? Is that something that we would expect Uber to do? And I think many people who end up taking an Uber rideshare service believe that, well, this is a very large, well-respected, emerging company, and so they're kind of implicitly vouching for the driver. Uber's business model, on the other hand, is to ensure that they set up their drivers as independent contractors and sort of insulate themselves from as much liability for the driver's actions as possible. And I think until that's worked out, consumers are running a bit of a risk of riding in an Uber vehicle without those issues properly sorted out. And so I'd love to see some legislation about this. Has there been any sort of legislation, or are municipalities starting to think about the ride-sharing problem?
Yeah, and actually Colorado, as it turns out, was a leader in the U.S. We were the first state to pass a ride-sharing statute. It went through the House and the Senate last spring, and that was a bill that was enacted with a lot of help from both Lyft and from Uber. So I think in their local situation, they saw an opportunity to try to redefine the rules proactively rather than be hit with things kind of unexpectedly on the regulatory side. So yeah, I think that law is now being looked at by a lot of other jurisdictions, and it lays out things such as mandatory background checks for drivers, annual inspections of the vehicle, some rules around how often the vehicle is used, maybe driver hours, things like that. I think many of the things that you bring up will be minor issues in a developed, established economy, and then huge, very complicated issues in somewhere like India, China, somewhere that doesn't have a lot of government familiarity with doing these kinds of checks. And so I think it's bringing up a key challenge for Uber. They want to grow, they want to go into all these markets, but as they go into a market that doesn't have that infrastructure, kind of reliable environment, they take on that risk, the reputation risk and the liability risk, and so that's a big concern. I guess no one actually mentioned the other big Uber ethical discussion around surge pricing, which any of you who have used Uber may have run into, where 2 in the morning on New Year's Eve, all of a sudden what used to be a $10 taxi ride is a $300 taxi ride. So they've gotten a lot of flack over that too. As a business school professor who teaches strategy, it's hard for me to quibble with a company that's taking advantage of supply and demand and trying to match those two things. And I think that's where you see taxi regulation probably as just vastly outdated, where the idea that a hotel would have to charge the same price for every room for every night of the year, or every seat in the Broncos stadium should be priced the same just because it's simple and easy to enforce. I mean, that's what we have with taxis. We pay the same rate per mile, whether it's New Year's Eve or in the middle of a blizzard or a quiet 3 a.m. Tuesday morning. And so Uber, I think, is just taking advantage and pointing out that maybe some of these things are a little bit beyond the times.
Oh, sorry. I would say that for me personally, anecdotally at least, when riding in an Uber taxi, I actually feel a little bit safer because I think that the crowdsourcing mentality of the reviews of the driver actually provides some level of protection that I don't think that you kind of get with a regular taxi driver. So I think that the issue of privacy is a little bit more of a concern for me. So knowing that my credit card information isn't out there, knowing that that's a priority for the company, and knowing that they're not tracking my every move would be nice, and that I think that would be something that I would hold that company to that standard of privacy. And also I think that you're right, they take advantage of this supply and demand, which is to be commended on one hand, but also not meeting the expectations of their customers or surpassing those kind of flat fees that they would expect it's definitely a little bit concerning. So
yeah, I mean they're in an interesting place where some of those concerns you mentioned around privacy put them in the boat of a Facebook or OkCupid. They're a digital company that have access to tremendous rich information about their customers, and then meanwhile they turn around and they're very much in the same realm as a taxi company that's been doing things with physical vehicles that have tires that need to be replaced and drivers that need to have background checks. And so they're trying to bridge a few different worlds, and no wonder they're getting a little flack at different angles from that.
Well, I think on the privacy issue, Uber really does need to be careful on this. I know Lyft has taken a number of very proactive steps to prevent employees from accessing, God view, and I think consumers in this day and age are starting to get a little more savvy about that, and they want to protect their privacy. So I think Uber's a little bit behind the curve here and needs to make sure that they don't lose market share by virtue of treating privacy as a sort of lax issue or a non-concern from their perspective. From the on the surge pricing issue, from the sort of ethics and law professor perspective, I actually also don't have a problem with it. It's not the same as price gouging. Let's say there's a natural disaster like a hurricane, and all of a sudden the shops start charging $20 a bottle for water, which is a necessity. It's not really a necessity to take an Uber car. You can always take the bus, public transit, walk, take a bike. And so at the end of the day, I don't have a problem with them using the laws of supply and demand in their favor.
Yeah, I think one challenge with any growth company is you can start with a very favorable demographic. Uber was really geared to be a high-end, very suave kind of experience to get in a black car and you feel kind of cool about the whole thing. They're trying now to appeal to every market. They've got Uber X, they have different flavors in different cities, Uber Family. And as you do that, then you run into different groups that may not be as liberal with their personal information, more uncomfortable with a company knowing what they're doing, and also may have different views about things like surge pricing, using an app, being clear on what the disclosure is when I click on this or that. And so, part of the growing pains now is they want to appeal to your grandmother, your parents, someone who doesn't maybe even feel comfortable on the internet, and suddenly that's a much tougher challenge to make sure that those customers feel equally treated properly.
Let me bring this back to another point. I'm a fairly regular Uber user, and for all the same reasons there and you brought up. But if a metropolitan area has a series of regulations about how livery services must operate, certain standards, just because I call myself an information service and not a livery service, and besides that, I'm a good thing, I'm a disruptive technology, I get to avoid those regulations, which is basically their theory. Or if you want to take me up on those regulations, I got more lawyers than you do and more lobbyists than you do, so we're gonna break the law.
Well, I think they're taking an aggressive approach and maybe taking advantage of uncharted territory in the regulatory world. As Paul was mentioning, most states, most municipalities are still behind the sort of ride-sharing technology. They haven't quite gotten their legislation up to snuff. And there are, of course, some ambiguities in existing law. And so, they're taking an approach that's pretty aggressive. We're gonna sort of challenge that ambiguity. We're going to assume that we can fit into it, or that there's no law preventing us from doing it. And it's they're placing the onus on regulators to come after them. And certainly with a $41 billion valuation, they have the money to lawyer up when they need to and fight it.
Yeah, I mean, you can't really win that game in the long run. If the general public feels that the company is completely abusing their role and continuously violating customer trust, maybe these scandals continue, I can't see them evading regulation forever. But if the values they do provide, for example, people that would never have considered being taxi drivers. In fact, some of my students here at DU who are now doing ride sharing as a way to make some money on the side, either for Lyft or Uber, parents who are getting their children from point A to point B. If those sorts of things are of value and the general public gets attached to them, then I think Uber's going to be in pretty good shape, and all those regulatory issues will get figured out over due time.
Well, I think the most powerful thing Uber has going for it is such a greatly user-friendly, high-value, high-service operation, and who cares if they break a law here and there? Anyway, you're going to let me get away with that.
No, I think we all should care whether they actively break the law or not. Yeah.
And I think there's an urgency to develop standards and regulations for disruptive technology in companies such as Uber, so that there's not just this delay and this waiting for regulation to catch up. I think it's urgent.
Yeah.
So I think I'll keep the word scoundrel but cross out outlaw. Okay. All right. Good. We're making progress. Great. Thanks. That was a good conversation. Good. We're going to do some quick hit questions. By that I mean they're not going to be short questions. They're going to be short answers, right? And so we'll hit these pretty quickly. The first question has to do with wage growth or the lack thereof at corporate decisions and income disparity. In early January, the Labor Department reported that average hourly wages, in fact, dropped for the month. In fact, for the first time in 3 decades, manufacturing jobs paid less than the average for all jobs in the private economic sector. Aetna Incorporated, the huge insurance company, on the other hand, announced its plans to raise the wages of its lowest paid workers by as much as a third. About 20% of Aetna's workers will see their pay rise to a new floor of $16 per hour. Citing Thomas Piketty's book Capital in the 21st Century that decries the growing disparity of wealth and income, Mark Bertolini, Aetna's CEO, commented, quote, "Why can't private industry step forward and make the innovative decisions on how to get this done?" End quote. So, why don't other companies follow Aetna's lead?
I think that they don't follow Aetna's lead necessarily because they don't have to. And that's just the issue, you know, if there are willing workers that are willing to work for a certain wage, then that's what companies are going to do. But I think it's commendable that Aetna is doing this, and I think that more companies should step forward and take that kind of action.
Paul?
Yeah, I think what I wouldn't want to happen is we see Aetna do something and then we draw the conclusion that all companies should do this. Let's make minimum wage $16, or let's model what one company does and make it a rule for all. I think what you want is companies to make that choice. Do we want to be a more favorable employer? Do we want to compete at more of a value kind of proposition, or are we a low-cost, bare bones insurance company? I think there's room for both, and obviously certain employees will gravitate to one or the other. But what I would hate to see is to make one company example the next rule that we all should follow.
Bruce, what do you think?
I'm going to disagree with Paul on this. The wealth disparity in the United States and globally is a tremendous problem. Oxfam just came out with a study that said that in the next year, the top 1% of the population of the world is going to own 50% of its wealth. That's a tremendous problem. I also think, that's something that needs to be addressed. I think business can and should address it by increasing wages, and I think that's smart business sense too. You'll be able to attract better workers, retain them longer.
Yeah. So I think all in moderation. So minimum wage can fall behind inflation. I think it definitely has in this country if you look at when it's been increased. But at the same time, to go all the way to a wage of $16 an hour, that may mean that someone who wants to work part-time, a few hours a week, someone who's semi-retired who wants to have some income, that person may not get into the job market in the same way. And so these tools can be effective in moderation, but you can also go too far, I think, and I'd be concerned that this whole goal of wage inequality, you may not get there just by raising wages, although it may seem counterintuitive.
I agree that there's not a one-size-fits-all standard and that we shouldn't expect all companies to do exactly the same thing, but I do think that we should expect all companies to do something.
Should we expect companies to take the lead, to set the mark, to be a role model for other companies? Aetna is a pretty well-respected organization, right? So is this a reasonable role for a big, heavy-duty insurance company to take?
Ideally, business takes the lead in this, decides that it's in their own best interest to raise wages, because if they raise wages, they're also increasing their consumer base. Their own employees can buy their own products back at a higher price, which is, tremendously good business sense. At the end of the day, I think expecting every business to raise its wages is probably unrealistic. And so I think there is a role for regulation here as well.
Good. All right. That was quick. We'll move on to the next one. Standard & Poor's, the bond rating agency accused of inflating the quality ratings of financial instruments that failed during the 2007-2008 financial crisis, has argued in the court of public opinion that it was unfairly targeted for investigation because it had downgraded the U.S.'s debt in 2009. Also, their attorney described the company's statements that their ratings were, quote, objective, independent, and uninfluenced by conflicts of interest, end quote, as mere sales puffery. So don't these kinds of statements seem rather boorish, coming from a company that was at one time among the most respected financial institutions in the world? I mean, sales puffery?
While certainly puffery is a defense to certain claims of fraud, there's a huge difference between sort of your standard sales puffery and what S&P has done in this case. What S&P has done is effectively said that their ratings were objective and not biased, when in fact they were faced with huge conflicts of interest arising from the fact that the issuers, their clients are paying them for ratings. And the higher the rating, the more money that the issuers make. This is a tremendous conflict of interest, and ultimately S&P is smart for getting ready to settle this case. They're going to lose.
Yeah. So I think it's an example where the threat of a huge government penalty can create maybe some more honest comments from a company. But at the same time, I agree with Bruce. Obviously, there's a conflict of interest, particularly in these mortgage-backed securities that played a big role in the financial crisis, where instead of rating a company, which has a lot of moving parts, can't really be manipulated very well, a mortgage-backed security where you're literally putting the items into that pot and you have total control over what the ingredients are, that was a particularly ripe situation for a conflict of interest. So no disagreement there. I guess the one caution I would have, having done some research in this area, is there's no perfect model here. So we obviously have conflict of interest when the issuer of a bond is paying a rating company to be rated. But if you get rid of that model, then maybe there's a lack of information in general, or investors are not maybe willing to pay one by one for ratings, and we have a dearth of information altogether. So S&P may take a little hit here, but I think they know, and we all know, that this model is pretty well necessary to get the financial market moving. So
I don't have a lot to add to what these guys have said. I think that's all very true. I would say from an accounting standpoint, transparency is really important when it comes to ratings like this and how they're developed and how they come up with them. Absolutely. And what's behind them.
Good. Okay, great, thanks. Over the past year or so, the Institute for Enterprise Ethics has hosted discussions on several issues having to do with the National Football League. We talked about the toxic culture in the Miami Dolphins locker room in 2013. We discussed the brouhaha around off-field violence that affected several of the teams last year. But now we have an issue of overriding ethical significance. Deflategate is upon us. The accusation that the New England Patriots deflated their footballs by 2 pounds per square inch to get an unfair advantage over the Indianapolis Colts. Now, panel, I know this is a very important matter, very weighty matter. And it brings up a host of challenging and complicated ethical questions. So how should we think about this one? I, for one, think it's a bunch of hot air, but not quite as much as I had expected. What do you think?
I mean, this cheating scandal has definitely deflated my hopes for an honest Super Bowl, but I think it's still going to be a ball.
Puns aside, I think that I'm no expert in thermodynamics, but I would want to, before we scream foul play, I would want to make sure that we've ruled out any other reasons why a football might lose air. Again, I don't know what those reasons might be, but I think that it's important that we rule them out. And then I'd also want to know what are the other teams doing. We should be checking all of the footballs. If we're going to crucify one team over this, then we should be aware of what other teams are doing and whether or not it's something that's common across the industry.
Yeah. So Bruce has stolen my puns, but I think the issue of reputation comes in here too, in that the accused party, it's not their first time being accused of some sort of gamesmanship, ethical violation. We had some surreptitious videotaping of an opponent's practice in the past and some other issues. And so I think this is one where a first offender might get some benefit of the doubt, but when you have a reputation, it follows you. And here the Patriots seem to be repeating a pattern that they've done in the past.
Well, nobody likes Bill Belichick, and he's so surly and grumpy.
And Pete Carroll is so happy and exuberant. So.
Okay, any other comments on Deflategate? We're going to have to watch how this, they have a person of interest, I hear.
Yes.
Yeah. All right, thanks.